Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, founder and CEO of KKM Financial. He joins me to discuss the strength and sustainability of this rally in front of what's going to be an incredibly busy week next week when we get the Fed's rate hike decision and, of course, a heavy week in earnings as well. It's great to see you as always, Jeff. Welcome back to Trade Talks. And I want to start with the strength and sustainability of the rally that we saw in January, because it feels as if the breadth is certainly much more broad, encompassing value and growth than in other rallies that we've seen recently.
You're absolutely right, Jill. It's almost tangible to feel the difference. We closed the door on 2022, which was a horrific year. But let's look at the Nasdaq 100, which was the laggard last year, down over 30%. And sure enough, we are seeing some of these names, some of these beat up names. You remember the dog and the Dows? Those were the worst stocks in the Dow Jones. I kind of came up with a name on CNBC. It's called the Nasty of the Nasdaq. And Lucid, Tesla, AMD, and NVIDIA. Those names were just absolutely obliterated in 2022. Now you're seeing them all up nearly 30, 40%. So it's tremendous to see. And Lucid today had some speculation. We'll talk about that maybe later, but it's speculation of a Saudi Arabia fund takeover. So it's up nearly 100% at one point, near $15. Now it's backed off a little bit. But to see this volatility, I think it's actually phenomenal, because you remember, Jill, all the days we've talked about the VIX. You're seeing the VIX down there at 18. And it's so important for investors and traders, remember, globally, that volatility can take markets up in the same manner can take markets down. So here we are sitting above a lot of the 200-day moving averages, which seemed like it was a small miracle to see the S&P 500, the Dow Jones, and now the Nasdaq get above that 200-day moving average, because that continued to be short-term resistance. But it seems like earnings season, despite the fact it's slightly bifurcated in the messaging, right? Banks are very prudent. They're talking about recession. American Express saying we had a record quarter. Despite the fact we missed on top and bottom, we're going to blow it out. And you saw investors buy that. So this bifurcated message is favoring the bulls.
And Jeff, it's so interesting, and I have to give you a shout out here, because out of all the traders and strategists that I've had on the show in Q4, you were the most constructive in terms of the market finding some footing, at least in the beginning of the year. Remind us of those reasons why you weren't quite as bearish as some of the other traders that have come on. You really have been quite constructive.
Well, thank you for the hat tip. I appreciate that. And the one reason I go back to why I found that ability to be constructive, that cautious optimism I shared with you and all the Trade Talks folks, was due to interest rates. As you know, I cut my teeth in the fixed income pits in Chicago, and trading all those treasuries back in the 90s allows me to continue to look for bond leadership. And what did we see? We saw in the month of October, we saw the 10-year note, the max yield, they popped up to nearly 4.30%. That move higher was just the velocity in that move we have never seen before. We remember we started out the year at 1.5%. So to see nearly a 300 basis point move in the 10-year, after that October, which coincided with the S&P 500 low for 2022, you saw some tranquility coming to the interest rate market. You saw volatility calm down, and that lag effect has spilled over. So that constructive forecast I had was due to the fact that I was seeing interest rates calm down. Now we're seeing, as PCE data came out today, we are seeing inflation indeed abate. So this is putting the Fed in a position. It's not quite Goldilocks, but it does paint the picture of this soft landing. I think they obviously are going to raise the CME Fed Watch tool was at 99.1% next week, that they're going to raise by another 25 basis points. But I think they have the ability to sit on their hands and watch the market come back and watch inflation continue to come down. But it all goes back to the bond market, Jill, being that guiding light.
And any sectors or areas of the market that you still are constructive on? Because again, this was a pretty strong rally. And do you continue to add to some positions here, or do you kind of wait till we get through next week and see what happens with the Fed and perhaps wait for better entry points? Or do you're still as constructive as you were in Q4?
No, still constructive here. I think this is really interesting. And if we can see some confirmation, I've been waiting for the Nasdaq 100 really to get above its 200-day moving average. If we can see 3 consecutive closes there, I think that's going to put the bears in a bit of the hurt locker. The bears have really done a great job of selling these rallies. There's been bear market rally after bear market rally, but there will be a difference. But we have to get through earnings season. We have to get through the Fed. It's just fascinating to see how investors are now gravitating more towards forward guidance than actually top line and bottom line misses or beats. So it's a really fascinating time to be in the markets, but it seems like we want to go higher to test. It may not be sustainable another 5 or 6% higher, but I do have the end of the year forecast for the S&P 500 Of course, you read my 2023 outlook, Jill, but you know, my forecast for the S&P 500 is 4,600. It's not going to be a straight line to get to 4,600, but there is optimism in that forecast.
All right, Jeff, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.